welcome to DCM Shriram Limited Q4FY20 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Siddharth Rangnekar from CDR India. Thank you, and over to you, Mr. Rangnekar.
Thank you. Good afternoon, and thank you for joining us on DCM Shriram Limited's Q4 and FY20 earnings conference call. Today we have with us Mr. Ajay Shriram, Chairman and Senior Managing Director, Mr. Vikram Shriram, Vice Chairman and Managing Director, Mr. Ajit Shriram, Joint Managing Director, Mr. K.K. Kaul, Whole-Time Director, Mr. J.K. Jain, CFO, Mr. Amit Agarwal, CFO Designate of the company. We will begin the call with opening remarks from Mr. Ajay Shriram and Mr. Vikram Shriram, following which we will have an interactive question and answer session. Before we begin, please note that some of the statements made on today's call could be forward-looking in nature, and a note to that effect has been included in the conference call invite circulated earlier. I would now like to invite Mr. Ajay Shriram to give us a brief overview on the company's performance and his views going forward. Over to you, sir.
Thank you, Siddharth. Good afternoon, ladies and gentlemen, and a warm welcome to the company's earnings conference call for Q4 and financial year 20. The company recorded satisfactory performance during the tough business environment. The strategic initiatives taken by the company over the period and during this year have all contributed positively to optimize the operations, financial performance, and capital employed. We increased the alkali capacity by 332 tons per day, that is about 22% in April 19, commissioned the 200 kiloliters per day distillery in November 19, and started the 66 megawatt power plant in February 20 to replace old 50 megawatt power plants. These projects added to the turnover and earnings during financial year 20 and will provide benefits for the full year or in financial year 21. Simultaneously, we exited the bulk fertilizer trading business fully with the sale of our subsidiary, Sri Ganesh Fertilizers, which makes SSP. We also exited the underperforming hybrid seeds businesses at Vietnam and Indonesia. These steps will help us in more efficient use of capital. In our sugar business, we have contracted to export almost 19 lakh quintals of sugar and diverted almost 5 lakh quintals of sugar to ethanol. These steps helped us reducing working capital requirements by approximately 700 crores. In continuation to the strategic path of value addition to businesses through higher integration, the company has decided to enter into the business of country liquor within the ambit of the sugar business. The board has approved an investment of rupees 42.4 crores to set up the country liquor bottling plant with a capacity of 11,000 cases per day at Haryama, UP, our sugar unit there, as a forward integration of the sugar distillery operations. This would also enable swing capacity between ethanol and country liquor. The COVID-19 and the lockdown with effect from 24th March 19 did result in suspension of operations in some of our businesses. So a lockdown with effect on 24th March 20 did result in suspension of operations in some of our businesses. The sugar and bioseed businesses continued normal operations. All other businesses have restarted operations between first week of April and mid-May 2020. Fertilizer and SFS have reached normal levels of operations. Chlorovinyl, Fenesta, and cement businesses are operating at 50 to 70% capacity. The production is increasing in line with market demand. The prices of some of these products have been soft. We are taking all required steps to protect our facilities and people by adopting the best practices during these difficult times. We have also engaged and worked with the communities to support through them all possible steps. These include donations to government funds, manufacture and distribution of disinfectants and sanitizers, distribution of masks and gloves, spreading awareness, and working with the district administrations in supporting their efforts. Now I would like to share with you briefly business-wide developments. Sugar. The Indian sugar balance continues to be in high surplus. Sugar stocks as on September 20th are expected to be approximately 12 million tons against normal requirements of 5 million tons. COVID-19 has adversely impacted the sugar demand, and if the demand continues to be low, the inventory as on September 20 could be higher. The sugar year 2021 is expected to record higher production than 27 million tons expected for sugar year 20. The country is expected to export about 5 million tons of sugar in sugar year 20. It is imperative that India continues to increase exports going forward so as to manage its sugar surpluses. The ethanol program also requires further push. During sugar year 20, the industry expects to divert approximately 0.75 million tons of sugar to ethanol through cane juice or B-heavy molasses. The overall blending percentage for the country is below 5% so far in this year. In this situation, there is need for more steps by government to enable higher diversion of sugar to ethanol. The overall cane arrears in the country as on May 20 are expected to be approximately 20,000 crores, including UP's arrears of about 16,000 crores. The governments therefore have to continue with existing steps and take some further steps to enable the operations of this critical sector to continue without major disturbances. We completed the cane crushing for sugar year 20 in May 20 with a total cane crush of 598 lakh quintals versus 542 lakh quintals last season and a recovery of 11.92% in the current year on a comparable basis, vis-à-vis 12.09% in the last season. The recovery after factoring in the impact of diversion of sugar through B-heavy molasses to ethanol was 11.1%. The sugar inventory as on 31st May 20 is 40.5 lakh quintals versus 45 lakh quintals last year. This could be possible through higher exports and production of B-heavy molasses into ethanol. The second distillery commissioned in November 19 is working satisfactorily and has strengthened the overall business in all respects. We will work with government for further sugar exports in the coming months and also in the next sugar season. We are also taking all steps to maximize the overall ethanol production and also the B-heavy ethanol production. We have also decided to set up a country liquor business as mentioned earlier for further integration and value addition in the sugar business. This would involve investment of 42 crores and could also use up about 5 lakh quintals of molasses each year, which otherwise would have been sold in the market at a very low price. Chemicals. The prices of chlor-alkali have witnessed a significant correction over last year. Financial year 19 witnessed abnormally high prices, which was a result of high global prices as well as restriction on imports last year due to requirements of quality approvals by the Indian authorities. Normalization of imports at a time when domestic capacity was also increasing has led to a sharp decline in prices. The global and domestic prices have started stabilizing before the disturbances relating to COVID-19. Post-COVID-19 lockdown, the clear pricing picture is still to emerge. So far, however, the prices are range-bound. The domestic production capacity has gone up from 4.28 million tons on 31st March 19 to 4.5 million tons in March 20. The capacity may further go up by approximately 10% in financial year 21. The net imports of caustic soda in financial year 20 was 2.08 lakh tons versus 0.73 lakh tons last year. The domestic caustic prices are now aligned with the international prices. The trends in consuming sectors are mixed so far. The textile sector and the construction-related sectors are seeing slower start post-COVID-19 lockdown. This is restricting the capacity utilization in the caustic plants. We are reworking the implementation schedule of expansion of 700 tons per day caustic capacity in SAC Bharuch, along with the 500 tons per day flaker and a new power plant of 120 megawatts, taking into account the disruption caused by COVID-19. Plastics. The PVC business has recorded lower prices globally as well as in the Indian markets after COVID-19 disturbances. The prices have come down by US dollars approximately 150 per ton vis-a-vis pre-COVID levels. The experts expect slower improvement in prices for this item. The prices of carbon are firm and are expected to remain at these levels. With the commissioning of the 66 megawatt power plant at Kota, our cost structure will improve. 40 megawatt additional PVC capacity will also help us in optimizing the relative movements in PVC and carbide prices. Agri-inputs. This segment covers our SFS business, bioseed business, and fertilizer businesses. Shriram Farm Solutions, or SFS, is strengthening its focus on value-added agri-inputs. It is focusing on introducing differentiated and customized agri-inputs which can help farmers deal with evolving challenges in agriculture. With forecast of a normal monsoon and positive impetus in the agriculture sector in the country, the business is seeing good growth in Kharif 20 and also going forward. In bioseed, our efforts to diversify further into other crops is bearing good traction. Strategically, we have exited our Indonesia and Vietnam operations. We continue to focus on India and Philippines. Our product pipeline across corn, cotton, paddy and vegetables is good. This, along with normal monsoons, will augur well for the growth of business in financial year 21. In fertilizers, the government has removed ambiguities in the modified NPS 3 urea pricing policy. We are hopeful for positive movements in this direction. However, as a result of COVID-19, the government spending is under stress, which may lead to lower releases of subsidy during financial year 21. Fenesta. The business did well in financial year 20, driven by volumes in retail as well as institutional sales. This was achieved in a tough real estate market. System aluminum windows. This will help us in enhancing our customer segments and overall volumes. It will also enable us to meet more needs of our existing customers through a single source. Post-COVID-19 lockdown, the business has started well, actually better than the general expectations. We are seeing higher interest from retail as well as from project customers. We are also seeing faster mobilization of construction activities. The business has already achieved over 50% size vis-a-vis pre-COVID levels. Due to COVID-19 and the pressure on businesses, we are revisiting our fixed costs at the corporate level as well as the SBU levels. We are sure this will help us now and going forward. To sum up, we feel we are strengthening our businesses every year in terms of diversity of revenue profile, competitiveness, and consumer value proposition. We are also simultaneously ensuring healthy cash generation and an overall strong balance sheet. With this, I would now like to invite Vikram to take you through the discussions on our financial performance. Thank you. Vikram.
Thank you. Good afternoon, everyone. I will first discuss the highlights of our Q4 financial year 20 results. The revenues during Q4 came in at rupees 1,917 crores, higher by 2% year on year. The lockdown restrictions in March 19 adversely impacted the turnover by about rupees 156 crores, including deferment of rupees 67 crores in sales. The business-wise highlights are as follows. Overall sugar revenues grew 32% year-on-year to rupees 838 crores. This follows higher distillery sales, better sugar domestic volumes and realizations for sugar. Distillery volumes increased 83% year-on-year, consequent to the commissioning of our new 200 KLD distillery. Chemical segment revenues stood 32% lower year-on-year due to the lower ECU realizations by 35% year-on-year. Volumes were lower by 4% year-on-year, the COVID effect being 10%. Softer caustic liquid and chlorine prices both have driven ECU realizations lower. Value-added segment of Shriram Farm Solutions reported 22% year-on-year growth in revenue. The bulk fertilizer volumes declined as a part of the planned exit strategy. Hence, the net increase in revenues for the division was 2% year-on-year. The COVID-19 effect included loss of sales in chlorovinyl of rupees 49 crores, Fenesta rupees 17 crores, and other businesses rupees 23.5 crores. Ethanol sales of rupees 67 crores got deferred and likely to be made up in financial year 21. PBDIT in Q4/20 stood at rupees 355 crores, lower by 19% year-on-year, that is, reduction of rupees 84 crores. The adverse impact of COVID-19 was approximately rupees 56 crores, including deferment of rupees 25 crores. The main highlights of this is as under. The decline in chlor-alkali product prices adversely impacted the earnings by 158 crores. Overall, sugar PBDIT was lower by 28 crores year-on-year. The decline was mainly attributable to the following. Lower power tariffs by approximately 25 crores and deferment of ethanol sales by approximately 25 crores. Fertilizer PBDIT stood at rupees 76 crores relative to approximately rupees negative 30 crores during same period last year. That is a positive movement of rupees 106 crores. Rupees 91 crores out of this movement relates to provisions for reimbursement of fixed costs by government. We had created a provision of rupees 38 crores in Q4/19 and rupees 15 crores during April to December 19 on this account. The total provisions of 53 crores were reversed in Q4/20, consequent to clarifications issued by the government on this subject. Cement recorded profits with better realizations and lower costs. Bioseed and SFS have very short season in Q4 and recorded lower losses with increase in turnover. Let me now also share with you the highlights of the performance of the full year ending financial year 20. Revenues came in at rupees 7,767 crores versus 7,771 crores during 19. COVID-19 impact, as mentioned earlier, being rupees 156 crores. Sugar revenues stood 7% higher year-on-year at rupees 2,522 crores on account of higher distillery volumes by 23%, higher sugar exports, and higher domestic sugar prices up 8% year-on-year. Lower domestic volumes pulled down the overall growth. Chemicals revenues stood lower by 10% year-on-year to rupees 1,725 crores. ECU prices declined by 23% year-on-year, partly mitigated by higher volumes of 13% year-on-year. Turnover of value-added inputs vertical of Shriram Farm Solutions went up by 16% year-on-year Fenesta was up by 7.5% and cement by 7%. PBDIT declined by rupees 161 crores year-on-year to rupees 1,295 crores. PBDIT was impacted positively by additional profits from new capacities commissioned during the year. Chemicals impact of additional product production, rupees 142 crores, distillery, rupees 24 crores, and the cost reduction due to 66 megawatts of power plant, about 10 crores. SFS, Fenesta, cement, bioseed, and plastics also reported growth in profits. Chemicals PBDIT reduced 35% year-on-year to 633 crores in spite of higher volumes, as the softer prices had an adverse impact of almost rupees 500 crores for the full year. The reduction in power prices in sugar business had an adverse impact of rupees.
Requesting participants to please stay online. We've just lost the line for the chairperson. Requesting you all to please stay connected. We'll just have the chairperson reconnected to the conference.
Okay.
So you may please go ahead. Your line is reconnected. Thank you.
Okay. No, his line is cut.
We're just reconnecting the chairperson back. Just allow me a minute.
Vikram is not audible.
Requesting participants to please stay connected. We now have the line from Mr. Vikram Shriram connected. Sir, over to you.
I'm not sure where I went off, so I'm just taking a... Can someone...
We can hear you now. Babu, carry on, Vikram.
Sir, you were explaining the power loss due to power rate drop.
By the UP State Electricity Board.
Yeah, I'm just trying to find that.
The impact of power rate drop on the annual profit.
Okay. The reduction in power prices in sugar business had an adverse impact of approximately rupees 52 crores. As mentioned earlier, COVID-19 adversely impacted the profits by rupees 56 crores. PAT during financial year 20 was at rupees 711 crores versus 906 crores in financial year 19. The total capital employed, net of cash, went up by rupees 916 crores during the year. The net fixed assets went up by rupees 348 crores and net working capital by rupees 568 crores. The company could restrict the working capital increase by expeditious export of all sugar export quantity, approximately 19 lakh quintals, and by diverting over 5 lakh quintals of sugar to ethanol. Both these steps helped in reducing working capital by almost rupees 700 crores. The higher capital employed of rupees 916 crores led to net debt going up by rupees 358 crores. The overall net debt at about 1.5 times EBITDA is comfortable. The company has cash and cash equivalents of rupees 527 crores and adequate unutilized working capital limit. It has met all its business, financial, and statutory compliances and expects to continue to meet these obligations going forward. We continue to focus on keeping our working capital under control during these times while simultaneously enhancing sales value. We expect that these steps will enable us to have continuous positive cash flows going forward. Thank you. That brings me to the end of my conclusion, financial discussion, and we will be happy to take questions that you may have. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Tejas Sheth from Nippon India Mutual Fund. Please go ahead.
Yeah, good afternoon, gentlemen. Just two questions. Starting, I'm happy to see that over last 2-3 years, the capital allocation strategy of this company has improved substantially, where we have invested a good chunk of capital in high growth segments and cutting down or divesting the segments where we are not seeing much return on the capital. I just wanted to know, going ahead, considering that we have built up a good base of cash generation this year, and I think even going ahead, what would be the capital allocation strategy for next 2 to 3 years?
Thank you for asking this question. No, we've actually been always conscious, and we've realized that money is expensive. We've realized that the interest meter never stops ticking. No weekends, no holidays, no Republic Day holiday, no Independence Day holiday. So we are conscious of where we spend our money. And we've made actually 2 years ago, I think we shared with all of you, we made a long-term strategic plan of looking at which business we want to invest in. And our strategy is to move in that. So we are looking at investing in our chemicals business for growing the existing business as well as the value-added businesses. Similarly, we are looking at growing our Fenesta business. We are looking at growing our sugar and distillery business. We are looking at growing our Shriram Farm Solutions business, carrying that forward. We are seeing what more investment is needed in the research side of a bioseed business. So I think in terms of capital expenditure, we've got a structured plan where we want to continue growing and investing in a considered, wise way without overspending. I think that is the approach we have adopted, and we will continue doing that. Of course, the COVID-19 pandemic, which has affected the whole world as far as the business environment is concerned, has made us back a little bit and rework out our strategic timing of the investments we have online. I think that our board felt is the right thing to do. So we are working on that. But our plans to grow these businesses, as we have talked in the past and what I've shared with you just now, is very much on the agenda.
Yeah, so sir, any delay or deferment in the new capacity expansion of chlor-alkali?
Yes, we are reworking the time limits of how it's going to work out. We are discussing with our suppliers, we are discussing the market and seeing the market situation. We'll take a call on that in the next couple of months.
Okay. So my second question was, considering that chlorine is the co-product or byproduct along with caustic soda, and the current logistics issue is kind of would be impacting chlorine dispensation. Is that also impacting our caustic soda manufacturing ramp up post-COVID or post-lockdown?
Well, it is. You see, the caustic soda chlorine is an integrated business and we have to sell both. Caustic soda we can convert to flakes and store, but chlorine one can't store too much.
Yeah.
The good thing is that in our Gujarat factory, approximately 50% of our total chlorine production goes by a direct pipeline supply to 5-6 different buyers who are on a long-term contract with us. So that gives us a strength of buying, and they have started their production. Not at full capacity because their exports to Europe, etc. are affected, but they are picking up capacity. So in fact, in Gujarat, we are running today at over 60% our chlor-alkali capacity. In Kota, it's running even higher than that. So there is an impact on chlorine also. Both of them are impacted, but we are expecting over the next 3 to 6 months, production levels should keep going up.
Okay. So follow up on that only, we were looking to invest on the downstream products of chlorine. I think we also hired a business head to form up a business plan towards that. Can you just highlight on the status of that?
Sure. No, in fact, that is very much on the agenda. to move for value-added businesses in our chemical business. And because of this, COVID has got a little disrupted in terms of our discussions and the direction we are taking. But this is very much on the agenda. It is on the radar screen. We are working on that quite actively. But I do want to mention, the business head we have taken is not only for this, it is for our entire chemicals division. Yeah. So the gentleman who joined us, Mr. Shekhar, is looking after entire chemicals business in Bharuch, in Gujarat, as well as Kota. And overall, he's looking after this. This will include the value-added chemicals also.
Okay. So the last question, how you see the realization of caustic soda in over next 12 to 18 months, considering that the supply is going to pick up at a higher rate than the demand?
I wish I could answer that question, but let's be real. I think no one can predict prices. As we had mentioned earlier, 19 was an unusual year in terms of prices. International business is down. The corona pandemic impact is across the board all over the world. So our focus and attention is how do we improve efficiencies, how do we reduce our costs, how do we optimize our supply chains so that our cost is minimum in terms of delivery to the customer and our cost is minimum in terms of ex-works cost of production. So that is our focus and attention going forward.
Okay. Thank you, sir.
Thank you.
Thank you. We take the next question from the line of Rahul Veera from Abacus Asset Management. Please go ahead.
Hi, sir. So, sir, since we are delaying this chlor-alkali plant, what will be the outlay for FY21 and 22 capex?
Pardon me?
Sir, since we will be delaying the chlor-alkali plant.
Yeah.
So what will be the capex for FY21 without the chlor-alkali plant now?
You see, one, we still haven't worked out what the exact schedule of this project will be. It may be just playing around with a quarter, 2 quarter also. The total investments of this project is 1,070 crore.
Right.
Which earlier we were wanting to do in 2021 and 21-22 beginning. It may just get deferred by a quarter, 2 quarter, but exact we will know as and when we freeze the schedule.
Okay. Fair point, sir. And sir, current, I understand the volumes would not be there, but current ECU realization will be around similar to last quarter, Q4?
It's difficult to give numbers because right now the prices are changing every day. The focus is on volume increase.
Right.
Are changing very fast, but the global price are still range bound as CMD mentioned in his opening remarks. They are still hovering within the range only.
Right. I think sir, there was a large capacity that was going to come near Gandhigam by Kutch Chemicals for the chlor-alkali. Has it started, sir?
Yeah, that started in March, April, 500 tons per day.
Okay. So there'll be some pressure on the realization then going in the next 1 or 2 quarters. Right.
So right now capacity is not an issue. Everyone is operating at 60% only. So more capacity or less is not making a difference on the.
Fair point, sir. Thank you.
Thank you.
Before we take the next question, I'd like to remind participants, if you have a question, please press star then 1 on your touchtone telephone. We take the next question from the line of Anand Bhavnani from Unifi Capital. Please go ahead.
Thank you for the opportunity. Sir, I have 2 questions. First was on sugar business. Sugar business has seen some impact. You mentioned in the opening remarks 25 crores of less power sales and 25 crores due to delayed offtake of ethanol. Now, margins in this quarter, therefore, year-on-year are like down significantly. Last year we had EBIT margins of 36, now it's 23. So for next 12 to 18 months, what's your sense of this segment? Do you anticipate any quick turnaround or it will be a while? What's your opinion?
Ajit, JK. Ajit, no.
See, the margin here is an issue of product mix. We have made very heavy export during Q4. That's what is affecting the overall margin. Also, we did almost entire ethanol on B-heavy molasses, which has lower margin compared to C. So instead of comparing it on a quarter-to-quarter basis, will be good to look at yearly margin figures for your calculations or for making any judgment.
Sure. So if I were to now, look at from yearly perspective, you mentioned that, for caustic, 2019 was a great year, and then from middle of 2019 on, the prices started falling. So if I were to do a similar comparison for sugar, how would you place FY20 in terms of performance? Was it a normal year? Was it above normal? And how should we think of FY21?
So as far as sugar price is concerned, I would say this is supported by government policy, so it was almost normal kind of thing in terms of sugar price. Ethanol is again a regulated commodity, and power is also a regulated commodity, so we don't see any significant output price movement unless government changes its policy framework. The other significant factor is the cane price, which government still has to decide what cane price they will have for next year. So those two factors will decide what the margins will be going forward.
Okay.
And the margin you mentioned was probably affected also because of B-heavy molasses, which has lower margin compared to normal C molasses in this particular quarter.
Okay. Now, sir, in terms of capital allocation, you gave us a qualitative sense that, we'll be focusing on chemicals, Fenesta, sugar and distillery and bioseeds. So if you can quantify a bit, like over the next couple of years, what kind of ballpark CapExes you see for each of these segments?
JK?
I don't think it is done like that. There are proposals which are continuously under study. Depending upon how mature a proposal is and how attractive a proposal is at a point of time, it is taken up on that basis. But what CMD has stated is that these are the growth areas. Some of them are capital intensive, some of them are not. I mean, like bioseed or Fenesta are not very high capital intensive. They are more operating expense intensive. The main capex happens in chemicals and sugar only. So there is no fixed ratio. We will take it up depending upon the merit of the project at a point of time. But all these are growth areas is what CMD has indicated to you.
Sure. So, sir, in terms of capital allocation, do you have a internal quantitative metric that you follow, IRR or payback or ROCE? Which you can,
There are two things we have said earlier also, that one, keep our debt to EBITDA at around 1.5 and not to go in any case beyond 2 even in emergency. So that's one thing which guides the investments allocation. The second part is we have a hurdle rate. We look at least at project stage a hurdle rate of over 20%. But sometimes you do strategic reasons, a little lower hurdle rate investment also. But as far as possible, we look for more than 20%.
So this 20% the IRR rate that you're talking, is it?
This is ROCE.
Okay.
Yeah.
Fine. Thank you. I'll come back and meet you.
Thank you.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. We take the next question from the line of Pratik Tolia from Elara Capital. Please go ahead.
Yeah, thanks for the opportunity and good afternoon, sir. So just wanted to understand on the caustic soda and chlorine part, You said your capacities are already closer to 60% in Gujarat and even higher in Kota. So based on your discussion with your end customers, and you mentioned a lot of them are, in a long-term supply. How soon are they saying that they are able to ramp up their, utilizations to the pre-COVID levels so that our capacities can also go up to that? So what are they, talking about any sort of timelines or looking at any sort of, quarterly run rate or anything on that front?
We've had a lot of discussions and continuously keep interfacing with our customers. I think it's very difficult to give such a concrete timeline because besides the domestic market, we are also working on exporting our products on caustic soda flakes. One is seeing how that can help. That will also help us in terms of moving further. Or chlorine market, how to expand further geographically. So we are continuously working on improving capacities and balancing out the realizations. I think it's an ongoing exercise. And I think as the economy in general in India and outside India pick up, I think this industry too will pick up. As I mentioned earlier, we do feel in the next 3 to 6 months, we should be at a much better operating capacity than what we are today.
Better would mean somewhere closer to 75% sort of? Based on the current scenario, I mean, if the way things are normalizing or, the relaxation that we are seeing today, if things only improve from here, we think 75% we can achieve by, say, third quarter?
Look, I'll be honest with you. I think we are hoping we come to 75-80% in about 3 to 6 months. But it depends so much on the world economy. It depends so much on the world economy and how India's economy moves forward. But we should be 75 to 80% 3 to 6 months from now, yes.
Sure. Okay, got it. And so for CapEx, you said that there is some deferment. So other than that, we have only one CapEx that is of the country liquor, right? Or this is the confirmed CapEx for this year?
Yeah, and the normal CapEx, that's all.
That is the maintenance CapEx. That will be how much, sir?
Is anywhere between 125 to 150, but because of present situation, we are still reviewing it and trying to see what can be minimized there.
Okay, sure. Understood. And sir, what is the thought process in the agri business? This year we are expecting a normal monsoon and there is a lot of buoyancy in the agri sector. A lot of raw material reforms have also been announced. We've also been rationalizing on the products. So what is the strategy over there in terms of new launches and whether it's the seed part or the farm solution part? Where do we see our business now going forward after we've cut the tail and a lot of loss-making segments are out?
JK.
So see, there are two parts, Pratik, here. One is bioseed side and second is SFS.
Yeah.
SFS has a wider portfolio and it has launched several products in crop care chemical as well as growth nutrients over the period. Bioseed unfortunately hasn't launched very significant except in vegetable, tomato and some corn because of the last year being little tight agriculturally, so they haven't tried several new products. Also because of the issue for approval of new technology, their launch of new product is little less than what we would like it to be. Now, both these businesses in any case during April-May have reported better sales and better collection. Part of it could also be a preponement of sales because of the fear that farmers have about lockdowns. There is a feeling that they are preponing all the purchases. So the critical thing will be what happens in June and July. If the sales carries on with this trend, I think we will register good growth. If it is actually a preponement and June-July sales drop, then of course the growth will be less.
Okay. Just lastly, I forgot to ask, so what would the chlorine prices during the quarter Q4 and what is it currently, sir?
The current price, Pratik, as I said, is difficult to give right now because it is changing every day. We won't be able to give you the current prices. As far as Q4 ECUs are concerned, they were roughly same as Q3. There was not much change Individually also, they were roughly the same level.
Okay. But you could give some color on, today we are already on the 9th of June, so almost 2 months of the quarter and one week of this month has also gone. So almost 9 months have gone. So what average color on what is the sense on the prices?
As you know, our past policy, we don't share the data in between the quarter. It is only done at the quarter end.
So I'm not asking for specific numbers, but just, it is the similar trajectory of going up, down, some color on that.
We won't like to deal with the price situation more than what CMD has already said in his remarks.
No problem, sir. Thanks a lot, sir. Thank you.
Thank you.
Thank you. We take the next question from the line of Vivek Ramakrishnan from GST Mutual Fund. Please go ahead.
Thank you. Sir, sorry, we're all like a bit of a stuck record regarding CapEx, and that's because there are so many eastern Western businesses today. The sugar prices are down, fertilizer subsidy, we don't know when it will come, and chlor-alkali is volatile. So that's why the CapEx becomes very important. In terms of a certain quantum, you've guided that debt EBITDA will be max at 2x, even if there's an emergency, but it's already at 1.5x, and this year looks tough. And then there's this NUP 2015 related CapEx, which has to be incurred if the government dictates. So could you just give us a flavor on what is necessary CapEx and what you'll defer so that you'll maintain a debt EBITDA below 2.0? Thank you.
JK?
So see, tax is only one item which you manage when you have to manage the fund flow. There are several other levers which we are working on. CMD and VCMD indicated that through our aggressive exports and shifting of B-heavy, we have managed or we have been able to reduce the working capital requirement by 700 crores, which is not a small sum. So it's not only CapEx which will help us in managing the debt to EBITDA level. It is also the cost side which helps in increasing the EBITDA and also the CapEx. Now, we already said that the only sanctioned project right now is the Bharuch extension, which is 1,070 crore, which we are reworking out when should we take up, and that will be dependent on, this financing aspect will be one of the factors which will be considered. The only other project that we have announced, small project of this country liquor thing. So there is no significant capex which is planned other than this. So capex is already bare minimum. I think we will work on improving EBITDA and managing working capital so that we remain within this norm that we have just specified.
That's very helpful. Thank you very much. In terms of just one question on this NUP 2015 fertilizer, do you have to do any capex regarding that for the energy norms, or there's nothing which is slated for that?
I don't think the NUP, because I am not fully updated. Has NUP been announced?
We are not anticipating any significant capex for meeting NUP requirements.
Okay. Yeah. Thanks a lot.
Thank you.
Thank you. We take the next question from the line of Pritesh Chheda from Lucky Investment. Please go ahead.
Sir, I'm just confirming the chlor-alkali capex per ton, if you have to do now, is about 25,000 to 27,000 rupees per ton. Is that number correct? And when you say 20% ROC is my target ROC, so at the current ECU realization and the current EBIT that I see of about 9 or 10 rupees per ton or per kg, does that 20% ROC target meets at the current two questions?
So just wanted to clarify that this 1,070 crore, I think CMD had mentioned also, includes 700 TPD chlor-alkali capacity. It includes 120 megawatts power plant and a 500 ton per day flaker plant additional. So you can't, the composition of these particular products varies at different stages. you won't be able to compare the CapEx at different stages because of this reason. So we don't require 120 megawatt only for 700. It will meet the captive power requirement of the earlier extension also. So that's how this 120 megawatt has been derived. It's not only for this 700 ton per day, but I think our internal benchmarks only gives us that whatever expenditure we are going to incur is amongst the most efficient and competitive in the industry.
The second part
add to that, there is a cost reduction element in that also, as JK mentioned, because it replaces bottled power with own captive power.
So in this
extent of part of the existing capacity.
So in this 1,070 crore, the additional expenditure is basically the power side, right?
Power and 500 ton per day slaker plant.
Okay. And at the current ECU realization, which is looks like some 27,000, and the current EBIT, which looks like some 9 to 10,000. If you put a capex now, does it justify your 20% ROC, or it won't justify the 20% ROC in the current ECU?
See, there are two factors. We don't have the latest calculations based on today's ECU, but obviously in a commodity, you can't take the bottom of the cycle for a capex decision, neither can you take the top of the cycle for capex decision. So it is done on the basis of an average sort of thing. But my sense is that even at 26, 27, it should be very close to about 18-20%.
Okay. And I was
it is looking forward 18 months. That's the implementation time.
And I want to just clarify the capex for FY21. Now the capex for FY21 as of now is just the maintenance capex of 150 crores. Is that correct?
And the country liquor project of 4 that we have announced, plus depending upon the completion schedule that we freeze for 1,070 crore project, some capex for time equipments may have to be incurred, which may not be very significant, but it will still be there.
Okay. So even if you start this 7 TPD, in your opinion, now should be pushed to FY23 as commercialization?
I think let's complete our review. We will share the schedule with them at the earliest.
I was just looking at it. Do you mind